Well, I tell you, Tyler, if you just take a second to look at the Wayback Machine, you're going to find that the average correction of 10 to 20% lasts about 4 months going down and 5 months coming back. And the worst part is they come back with a vengeance in the beginning. So we're not timing. We haven't timed. We haven't gone to cash. We don't see a recession. So that allocation to equity is fully allocated. Be tactical. We don't own real estate. We don't own utilities. We didn't make the switch from Amazon to Procter & Gamble and now find ourselves wondering what we do with our Procter & Gamble stock. We're staying the course. We believe there's still growth. There'll be bumps in the road. There's always reasons to be concerned. But I'll bet most viewers can't remember what the worries were that caused the last 10% decline. It's kind of remembering who was the last person that lost the presidency before Trump.
Yeah.
So we're in it. We think it's good. No recession. Keep going. Be tactical, but keep your allocation fully invested.
All right, David, how about you? What do you think, and what do you think the effect of higher rates as we move into 2019? Higher rates and slowing profit growth could mean for the overall market and for individual sectors.
Well, we think the president and the administration has sort of directed the world to look at interest rates and the Fed raising rates. We don't think that's a problem. We think that's actually very, very manageable. We think the biggest problem and our concern is on tariffs and trade and China. If you look at this last quarter's earnings season, about 30% of the companies talked about tariffs and trade and China as the reason that they're a little bit more cautious in their outlook. Not one company outside of the housing stock said anything about rising interest rates. So when we look at the world right now, we're pretty comfortable with the Fed raising rates. We think it's the right course of action. We're at full employment. Inflation could be out there. So we think the Fed is doing right. We think if the administration makes any sort of positive progress with China, we think the economy would be in great shape and then the markets would be in good shape. So that's the thing that we watch out for most, not the Fed right now.
And Steve, how much have companies already priced in this idea that the Fed is going to raise rates and the difference between whether there's 2 or 3 next year?
You know, Contessa, I think that's a great question. I want to pick up what David said and maybe a little bit of old Rumsfeld comment, which is there's the known unknowns and the unknown unknowns. If you're investing right now without knowing that the Fed is going to raise rates next year, you're not paying attention. If you're investing right now with the understanding that earnings growth are going to slow, if only because the initial effect of the tax cut on a year-over-year basis is going to go away, you're not paying attention. And probably if you're investing right now without the understanding that growth is going to slow next year because of the initial impulse of the tax cut, again, you're not paying attention. Those are the things we know. And David had a nice list, I think, of what we might call the unknown unknowns, which is what is the effect of tariffs. And I would probably add to that, we don't know quite how much growth we're going to slow. We're going to be in the 3% range or the 2.5% range, or even right back down to trend at 2%. But those are the 3 things that you should not be surprised about in 2019.